We're almost at the end of part 1. Before we switch over to part 2, I want to run you through the 3 key facts you must remember about Forex. We've already learned Forex is zero sum, that's the most important fact, but there are 3 others which are also extremely important to know. They'll help you understand how the market works in terms of buyers and sellers, why supply and demand the concept generates price movement, and why your main focus in trading should always be on other traders. They're the key. So, ready to get started? Here's the first fact you need to know. For most traders, it's clear you can't buy without someone selling, and vice versa. If you want to buy, someone must sell. If you want to sell, someone must buy. That's just how buying and selling functions in a market. However, most traders never go any deeper than this. They don't realise the implications this has for how the market functions or how traders must operate. For example, which group of traders are doing the buying or selling, and what action is causing them to buy or sell. See, it goes way deeper than you think. Consider this. If you want to take profits off a buy trade, that requires buyers, because by taking profits, what are you doing? You're selling. You're selling some of what you bought, which requires other traders to be buying at the same time. No one buying, you can't take profit. You must wait for more to come in. Same goes for placing and closing trades. It's the same situation. If you want to close a sell trade, other traders must be selling. Because how would you close a sell trade? By buying back some of what you sold. That requires sellers because you're buying, so others must be selling. How much you want to buy or sell is also a major factor. The more you want to buy or sell, whether to take profits, place trades, or do anything else, the more traders who must be taking the opposite action at the same time. If you want to enter a huge buy trade, a ton of traders must be selling. If you want to take a big chunk of profit off a sell trade, masses of traders must be selling. Now, for us retail traders, what I've explained above isn't that important, because we don't trade at a high enough size to affect the market. We never need to worry about whether enough traders are buying or selling. Our actions, like placing trades and taking profits, are so small that enough buyers or sellers are always available. It is a problem, however, for the large traders, like banks and hedge funds, and this is why what I've explained is so important for understanding the market. The big players in Forex, because their actions, like placing trades, are so massive and have such a large effect on the price action, require huge swaths of traders buying or selling when they want to buy or sell themselves, whatever the action. If the banks want to enter a sell position, masses of traders must be buying. If the banks want to place a buy trade, thousands of traders must be selling. This simple fact puts a big restraint on what the banks can do and where they can do it, which we can use to understand them better. For example, here's a large down move on AUD CAD. What do you think most traders are doing right now? What direction do you think price is heading in, up or down? Obviously heading lower, right? Since price has been falling so heavily, chances are it's probably going to continue falling. So most traders right now are entering sell trades. They're selling because they think price is heading lower. Now, if a huge number of traders are selling, what can the banks do? What actions can they take with so many sellers? Well, they can do one of 3 things. They can take big profits off any open sell positions, because that requires many sellers. They can close out a large sell position, close their trades basically, or they can enter a big buy trade and cause a large reversal. From what I explained, we know those are the only 3 actions available to the banks when lots of sellers are free. So we also know that if price rises now, it's because one of those 3 actions have taken place. But which one is it? Let's move the chart forward. A little while later, price rises strongly, causing a new swing low to form. The only way price could rise is if someone bought up all the sellers, which can only be the banks, only they have the funds to do that. We know the banks have bought then, because we also know they've bought for one of 3 reasons, those I just listed a minute ago. Which one that is, we don't know, for sure at least. However, using probability, we can make an educated guess. The banks don't place big trades too often, because they need thousands of sellers. Price must have been falling for a long time, which it hasn't in this case. So chances are the rise isn't from the banks entering buy trades. It could be, nothing is 100% in trading, but it's unlikely. They also don't close sell trades that often, because again, that requires tons of sellers. While price has fallen strongly in our case, it's not fallen for a long time, not like a major downtrend when literally everyone in the market is short. Therefore, we can rule out the rise being caused by the banks closing sell trades, which would initiate a large reversal. That only leaves one other action, taking profits. Due to the size of the bank's trades, they must take profits often, far more frequently than entering or closing trades. They also don't require masses of sellers to take profits. They can just take profits based on how many sellers are currently free. The most likely reason for this rise then is the banks taking profits off their short trades that cause the decline. We don't know this for sure, but it's likely, and at the very least, it gives us some guidance on what to do. If the banks take profits, they obviously want price to keep falling, so the rise will probably resolve into a retracement. We should watch any nearby technical points closely. We might be able to get a nice entry into this down move. If we look at the chart, a drop-based drop supply zone formed during the last part of the decline. Even though these aren't great zones, they are points where retracements could end, making it a great spot to watch for a short entry. And lo and behold, the reversal resolves into a retracement, and where does it end? At the drop-based drop supply zone, giving us a great short signal. Then price reverses and we get into a nice trade. See how important it is to understand why buyers need sellers and vice versa now. More than anything else, this is how you can really get a sense of what the banks are up to. If you understand their actions along with what they need, buyers or sellers, you can simplify the market significantly, just like I did in the example, making it much easier to gauge what's going on and what price might do next. In section 2, I'll explain in some more detail and show you how to track what the banks are up to using probability and swing highs and swing lows. Like all markets, Forex is governed by two fundamental forces that together generate the price movement we see. The forces of supply and demand. Supply is how many traders want to sell a currency. Demand is how many traders want to buy. When we look at a price chart, what we're seeing is a visual representation of supply and demand in action. We're seeing first-hand demand and supply come into the market. That's creating the rises and declines we see. If price is rising, that means demand outweighs supply. If price is falling, that means supply outweighs demand. If price is consolidating, supply and demand are in balance. Here's how it looks on a chart. Starting from the left, we have a rise, so demand outweighs supply. The demand for GBP USD is greater than the current supply, causing price to rise sharply. The rise is sharp because the demand is extremely high, hence why price jumped higher with big bull candles forming. We see price sail off after these candles because more supply comes in. Higher prices are more attractive to sellers now, so price can't rise as far or as fast. We then see a reversal. Price stops rising and starts falling. Now supply has become greater than demand. The decline starts off slowly but gathers pace, again because supply picks up. The result is a couple of large bearish candles. They show supply jumping higher. However, right after the big bearish candles form, a ton of demand comes in and price shoots higher. Demand now outweighs supply again. After a while, price stops rising and begins moving sideways, creating a consolidation. Supply and demand are now in relative balance with one another. Supply is being matched with demand and vice versa. For price to now break out, either supply must become bigger than demand or demand must become bigger than supply. And as we can see, in this case, supply becomes bigger than demand. As a result, price breaks to the upside and an upswing continues. The reason I've shown you this is to highlight how important it is to understand why price moves at a fundamental level. It's just supply and demand. It's all too easy to view a price chart as simply red and green candles. I mean, is that what it technically is? Yeah, but it's way more than that. The candles show us the supply and demand balance, how much supply and demand is coming in and where it's coming in. That helps us understand what's taking place at a fundamental level. If we see a sharp decline during a long uptrend, that suggests a ton of supply has come in. Why would supply suddenly grow bigger than demand? Probably because more traders now think the current price is too high. So it's a possible sign the uptrend could be coming to an end. This is the advantage of really understanding price movement. When you look at it in terms of just candles, the sharp decline doesn't mean anything. It's just a sharp decline. Price moved lower, that's it. What's the big deal? When you understand what really happened, however, it gives you a different perspective. Price moved lower because supply drastically outweighed demand, which was really high, hence why price had been trending higher. That tells us the trend could be weakening. Supply must be increasing, otherwise price wouldn't fall in such strong fashion. It doesn't mean price is now going to reverse, though it could, but it does suggest the trend is weakening, so a reversal could be close. You can now use this to help get short or manage any open long positions. Always keep the concept of supply and demand in the back of your mind when you trade. It'll give you a real leg up in understanding what's actually going on and why price is changing, and when it might reverse. On to point 3 now. This may seem like an obvious point. I mean, of course people move prices. How else could price rise and fall? But it's one that a lot of traders don't fully understand the implications of and the impact it has on the market. Most Forex traders have this idea that there are just two groups of traders in Forex, buyers and sellers, who battle out for control. It's a nice idea, and in a sense it is true, but it's a massive oversimplification. Forex is full of different trade groups, all battling for control and vying to buy and sell for their own reasons and purposes. Banks and hedge funds are in the market to make a profit. Retail traders, people like you and me, also want to make a profit. Businesses buy and sell for corporate reasons. So while yes, we may all be on the same side at one time or another, we're not necessarily in the market for the same outcome. On top of that, we might not all be buying and selling for the same reason. For example, you might enter a buy trade to capture a move higher. However, a bank might decide to take profits off a sell trade. How do they do that? By buying back some of what they sold. They buy it back at a lower price, securing themselves a profit based on how much they sold. In this scenario, both you and the banks are buying. You're in the same group, but your reasons for buying are totally different. You want to profit from the rise. The banks want to secure an existing profit off a sell trade. You're conducting the same action, but with completely different motivations. Now, the result is the same, price moves higher, but the length of the rise will be shorter. Why? Because the banks only want to take profits. They don't care whether price rises, that's not their position. Remember, they're short already. Once they take profits, they want price to continue falling to make more profit. As a result, price won't rise that much, and we'll see a retracement form. Now, if the banks enter big buy trades, the situation will be different. In that case, price would rise for a long time, because the banks obviously want to make a big profit. This is why it's so important to understand that people move price. It's not just buyers and sellers, that's too simple. Multiple groups affect price via their actions, so you must learn how other people operate in the market to really understand what's going on. If you don't understand the banks, you won't know when they'll take profits, so you won't know if a retracement or reversal is probably underway. As a result, you may enter and get the market direction wrong, all because you didn't realise what was really going on. Let's now move on to the second part of this course, and I'll break down how the banks trade and how they profit in Forex by manipulating retail traders into losing money. See you in the next one, guys.